Tomorrow will be massive for stocks. I mean, this could really propel the small cap sector, the IWM, if you will, up maybe 4 to 5% tomorrow if we get some good news. Tom Lee and Fundstrat believe the S&P 500 will rally over 4% in the month of June, and tomorrow's data is critical to achieving that. Data that came out this morning that was good news for markets. Not to mention Nvidia falling about 1% today did allow the markets to breathe a little bit and to see some capital go into other areas of the markets and not just Nvidia, and I'll talk about that as well. So first and foremost, hit the like button and subscribe to the channel if you have not done so already. It's free 99, but more importantly, let's get into 5 reasons the stock market is headed for a 4% gain in June, according to Fundstrat. The S&P 500 is primed to rise 4% in June, according to Tom Lee. Lee highlighted 5 catalysts that could drive the stock market higher next month. We see positive supports for stocks in June, hence buy the dip if it comes, Tom Lee said. Lee said the S&P 500 could jump to 5,500 within the next month, driven by 5 positive market catalysts. The first catalyst is bullish seasonals. Since 1927, there have been 17 instances when stocks were up in the first quarter of the year and then saw a decline in April. This setup, which has happened already this year, bodes well for strong gains in May and June. Lee highlighted that the win ratio for stocks rising in June is 100%, with a median gain of 3.9%. Such a gain would send the S&P 500 to new all-time highs. The seasonal argument alone is positive, Tom Lee said. That's why we still think there's gas in the tank. The second catalyst is inflation, or rather continued disinflation, according to Lee, who is expecting several favorable inflation data points over the next few weeks. That starts with Friday's release of April core PCE, followed by the release of May CPI on June 12th. A continued decline in used car prices, a surge in new car inventories, and declining trends in owners' equivalent rents all give Lee confidence that inflation should continue to move lower. If that does happen, the likelihood of rate cuts should rise in the second half of this year. Tom Lee said, I think the odds of the number of Fed cuts by the end of this year is actually going to start creeping up. The market currently expects just 1 interest rate cut in 2024, and if more cuts begin to get priced into the markets, that should act as a tailwind for stocks. But keep in mind, it's important why you're going to get rate cuts more than if we're going to get rate cuts or not. If we're going to get rate cuts because the economy is going down the toilets, doesn't matter if we're going to get rate cuts. That's still bad news for stocks. Now, if we get rate cuts because the economy is holding up and inflation is falling, well, that is good news for stocks. The third catalyst, according to Tom Lee, is that investors have a low utilization of leverage, which suggests the type of euphoria often seen at market peaks is nowhere to be found. Lee highlighted that New York Stock Exchange margin debt of $775.5 billion is still 17% below its 2021 peak of $936 billion. Fourth catalyst to push stocks higher in June is the record $6 trillion sitting in cash on the sidelines, but Nvidia's blowout earnings results last week could jolt investors to finally put that cash to work and buy stocks, according to Lee. Finally, the fifth catalyst that should push stocks higher in June is solid corporate earnings results, which show that profits continue to rise. He said, quote, earnings season shows the fundamental story of the economy is intact, and I think AI is getting stronger. With 97% of S&P 500 companies having reported first quarter earnings per share have beaten consensus estimates by 3%, and while the earnings gains were led by Magnificent 7 stocks, the other 493 stocks in the S&P 500 delivered solid results, according to data from Bank of America. Moreover, despite concerns around high expectations for Q2 earnings estimates for the remainder of 2024, slightly rose quarter to date, Bank of America said in a note on Tuesday. Now, something I've talked about a couple of times here on this channel ever since Nvidia really beat on earnings was Nvidia has been sucking the liquidity out of our markets until we get an external source that starts adding liquidity again, whether it's the Fed or it's the money, $6 trillion on the sidelines coming back into stocks. If you see a single stock like Nvidia that drives hundreds of billions of dollars in market cap gains in a single day, that money's coming from other areas of the markets. And there's just not enough money to continue to support that kind of rally. And it makes it even worse that AI is the new craze. And, well, if you're a hedge fund manager and you don't own Nvidia, then you have some problems, right? At least before, Nvidia's quarter earnings. Now everyone had to get reallocated to Nvidia. If you weren't in Nvidia before, I'm sure you are now. So the mentality has been sell these other stocks that aren't doing anything because Nvidia is rallying. And whether Nvidia rallies or not, our clients want to own Nvidia. So you almost have to own Nvidia if you are an institutional investor. Now that you are seeing Nvidia actually falling about 1%, that frees up a lot of money to go into other areas of the markets. And I think that's probably the biggest reason why small cap stocks are actually doing well today. And it's not just small cap stocks, other stocks like a Tesla also doing very well. We did have some data that came out today that kind of sweetened the deal, if you will, for buying small caps, interest rate sensitive names like a Tesla. You had GDP growth rate quarter over quarter second estimate for Q1 that came in line with expectations of 1.3%. Last quarter GDP was 3.4% and the consensus was around 1.6% is the number we would come in as. So you came in a little bit lower than the forecast number here. Consensus was 1.3%. So maybe I should say forecast 1.6, consensus 1.3. You came in at consensus. That's seen as good news by the markets because presumably if the economy is not running as hot as it was, in prior quarters, maybe that means the disinflation story can continue. Now, corporate profits quarter over quarter did fall to negative 1.7%. The forecast was 4% and consensus was 3.9%. So that maybe means, hey, if you're not seeing corporate profits as good throughout corporate America, not just in the stock market, then maybe that means less hiring. Maybe that means a weaker economy or weaker labor market, which is, what the markets want to see at this point. I don't think that's the right way to think about things. I think you want to see the economy and labor market as strong as possible, but the weaker these data points come in, the more the markets like it. So that's definitely giving a little bit of a boost to small cap stocks as well today. And you did have initial jobless claims. It came in about 1,000 higher than estimates. Estimates were 218,000. You came in at 219,000. Pending home sales month over month also came in at negative 7.7%. You were expecting negative 1%, so that was a downside surprise there. And pending home sales year over year came in at negative 7.4%. The estimate was positive 0.5%. So some disappointing real estate data did probably help boost the markets as well today. Now, you do have some earnings today and after hours as well. Maybe by the time you guys are watching this video, these earnings are already out. You have Costco, Dell, Zscaler, Marvell, MongoDB, Ulta Beauty, Centennial One, NetApp, Viva. I think Dell has also taken quite a bit of money out of our markets or just random stocks as well, your small mid-cap stocks. Dell has went absolutely parabolic. It's only a $135 billion market cap company, so it's not as big of a deal. Nvidia adds that basically every single day, right? But if Dell does give back a little bit, maybe that could lead to a further sell-off in Nvidia, and maybe that could lead to more money going into other areas of the markets. But it's really all going to come down to what happens with the data coming tomorrow. Tomorrow, you will get core PCE price index month over month for April. You're actually expecting the best number for 2024, right? The number that has showed the most disinflation. You're expecting a 0.2% number. Last month, you were at 0.3%. Now, it does matter where you actually come in because we see whole numbers here, but the number itself is not a whole number. It's down to the actual decimal point. So if you come in at 1.5 or 0.15, 0.15, then you'll get rounded up to 0.2. That's a really good 0.2 though. It's going to read 0.2, but it's really like halfway between 0.2 and 0.1. But there is the rounding effect. Now, if you come in at 2.4, then you're going to get, rounded down to 2, but it's not going to be as great. Preferably, you want to see like a 0.15, 0.16, 0.17. You want to see something under 0.2 itself, right? And if that happens, then I would expect a 4 or 5% rally in small caps could make sense. And I think the odds of a cut coming July 31st will dramatically start to rise as well. You are also going to get personal income month over month, expecting that as 0.3%. Last month, you came in at 0.5%. And if people are making less money. Presumably that's less wage inflation and less chance of a wage price spiral. That's kind of how the markets are going to look at it. And then personal spending month over month, another very important number. Last month you came in at 0.8%. You are expecting 0.4% for tomorrow. Again, less spending, less inflation, seen as a positive for bringing down inflation. And then and all of that data comes out at 8:30 in the morning tomorrow, Eastern Standard Time. And then at 9:45 in the morning, you will get the Chicago PMI that will come out. We're expecting 39. Last month was 37.9, and a weak number there would be welcomed for markets as well. And that's pretty much it throughout the day. You do get some oil rig data that can move oil markets. Not expecting that will be really a catalyst at all. And then you have Fed Bostic that speaks at 6:15 p.m. tomorrow. And usually those after hours Fed speakers don't do much. They don't move the markets at all, but they can. The percent of stocks above their 50-day moving average today is up to 47.76%. This is a rise of 14%. You actually have 6% of all stocks out there on the markets today breaking above that 50-day moving average. This is one of those days where 90+% of stocks are in the green today. So that looks pretty dang good heading into PCE. Then again, the last week or so has been super negative for your average stock, for your small and mid cap stock. So I don't think it tells you too much, but you are really green heading into a big data report tomorrow. I would say that is good news. And I do think if PCE comes in on the low side of 0.2%, that could lead to a 4 to 5% rally in small caps and maybe a 1% rally in S&P and NASDAQ. I think they're better priced for a low PCE number coming out. But this could really mark a rally for the rest of the summer. And if you take a look at small cap stocks on a technical basis, if you actually look at the charts, the 50-day moving average is at $202.89 per share. You were under that yesterday. You pretty much gapped up above that today. And now you're trading just under your 20-day moving average at about 205.31. So I think if you do get above that 20-day moving average, that could set you up for a run into the 208 level coming potentially tomorrow. That would be a 2% rally. If we did get a 4% rally, that could set you up for a move to about 212 on small caps. And that would be back to precisely the high that you've seen on March 28th. And I think, honestly, you're setting up for what could be a perfect storm coming tomorrow for small cap stocks, for this whole entire segment of the markets that has really been overlooked and discounted for a very long time, trading at super low valuations. I mean, nobody wants to own small caps, but if inflation really starts to fall and we can get more cuts in 2024 than just one, I mean, that's setting you up for a very good scenario as earnings start to reaccelerate again in Q3, Q4 of this year and into 2025. I think you could see a lot of cash get allocated to this area with the right news and data coming out tomorrow. So let me know what you think about this information down below in the comment section. Tom Lee's bullish. I mean, I think that says enough. I think, Tom Lee being bullish on inflation coming down tomorrow, likely is a good sign that it will. Now, Tom Lee doesn't know everything clearly, but he does tend to be spot on with these specific inflation reports and certain catalysts overall. So let me know what you think down below in the comment section. Let me know how you are positioning your portfolio as well down there. Nonetheless, that is it. Enjoy the rest of your day, and I will see you in the next one.